Sophia buys gold. Liam puts the same money into the S&P 500. They both think the other one is making a rookie mistake. One of them sleeps great during every crash. The other one sleeps great during every boom. And when you actually run the numbers over 20 years, the answer will mess with everything you thought you knew about both. Let's keep this clean. Sophia and Liam both come into $50,000 in 2006. Same age, same income, same financial literacy. The only difference is where they park the money. Sophia buys gold, physical coins stored in a safe. She adds $300 a month to her position, buying more gold every single month regardless of the price. She believes in it. She's read about central bank stockpiling, about the dollar losing value, about what happens when governments print too much money. She's not speculating, she's protecting. Liam puts his $50,000 into an S&P 500 index fund. He also contributes $300 a month. He doesn't pick stocks. He doesn't watch CNBC. He sets up a direct deposit and goes about his life. When people ask what he invests in, he says the S&P. They nod, they change the subject. Nobody writes a blog post about it. On day one, Sophia has something she can hold in her hand. Liam has a number on a screen. That difference will matter more than either of them realizes. Not financially, but psychologically. And psychology is where most investors lose the game. For context, gold was trading around $600 an ounce in early 2006. The S&P 500 was sitting near 1,280. Neither of them knows what's about to happen. 2 years in, the financial world starts cracking. By September 2008, Lehman Brothers collapses, and the S&P 500 enters freefall. From its October 2007 peak to its March 2009 bottom, the index drops roughly 57%. Liam watches his portfolio go from approximately $72,000 to around $38,000 in about 17 months. That's not a number on a screen anymore. That's a gut punch every time he opens his phone. Sophia, gold surges. While the market is cratering, gold climbs from around $700 to over $900 an ounce. Her portfolio doesn't just survive, it thrives. By early 2009, she's sitting on roughly $85,000 while Liam is staring at $38,000 and wondering if the entire system is broken. The gap at that moment is staggering, and Sophia feels like the smartest person in every room she walks into. This is the part the gold crowd loves to screenshot. And they're not wrong. During the worst financial crisis in 80 years, gold did exactly what it was supposed to do. It held, it climbed, it proved itself. But here's the problem with picking your scoreboard at the moment your asset looks best. By 2011, gold hits its first major peak, roughly $1,900 an ounce. Sophia's position, with her initial $50,000 plus 5 years of $300 monthly contributions, is worth approximately $150,000 to $170,000. She feels untouchable. Then the bottom falls out. Over the next 4 years, gold slides from $1,900 down to about $1,050 by late 2015, a 45% decline. Sophia doesn't sell, but she watches nearly half her gains evaporate. She keeps buying through the decline because she believes in the thesis and that discipline will matter later. But from 2013 to 2018, gold essentially goes nowhere. 5 years of sideways. 5 years of her friends asking why she's still holding that rock while the stock market is ripping. Because while gold is stagnating, Liam's S&P 500 is on a tear. From its 2009 low of 666, the index climbs relentlessly. 1,400 by 2012, 2,000 by 2014, 2,700 by 2017. Liam's portfolio, with consistent $300 monthly contributions and dividends reinvested, has ballooned to roughly $180,000 to $200,000 by 2017. He didn't do anything clever, he just didn't touch it. Compounding did the rest. At the 10-year mark, the score isn't close. Liam is ahead by $40,000 to $60,000. He put in the same amount, took the same risk of doing nothing, and the stock market's average annual return of roughly 10 to 11% simply outmuscled gold's flatline decade. Sophia's total is respectable, around $130,000 to $140,000, but the compounding engine of the S&P 500 is pulling away. Then the world gets weird again. COVID-19 hits in March 2020. The S&P 500 drops 34% in a single month. Liam's portfolio, which had grown to maybe $320,000, drops to about $210,000 before recovering. But gold breaks $2,000 an ounce for the first time ever. Sophia's position surges. Then comes 2022. Inflation at 40-year highs, rate hikes, war in Ukraine. Gold holds, stocks stumble. Then calendar 24 and 2025 bring a historic gold rally. Central banks buying at record levels, geopolitical instability, the dollar under pressure. By early 2026, gold is trading above $4,700 an ounce. That number is almost 8 times higher than Sophia's starting price. Let's do the final math. By April 2026, Sophia's gold position, $50,000 invested in 2006 plus $300 a month for 20 years, is worth approximately $650,000 to $750,000. Her total contributions were $122,000. The rest is pure price appreciation. No dividends, no earnings reports, no company she needed to research. Just a metal that's been valued for 5,000 years doing what it does during periods of instability. Liam's S&P 500 portfolio, with the same contribution schedule and roughly 10 to 11% average annual returns, including dividends, is sitting at approximately $400,000 to $460,000. Solid, impressive. The kind of return most financial advisors would celebrate with a handshake and a brochure. But Sophia is ahead, substantially ahead, and almost nobody predicted that 20 years ago. Now here's where I have to be honest about what this does and doesn't prove. Sophia's 20-year window includes 2 generational crises, a pandemic, a European land war, a Middle East conflict, a historic inflation spike, and unprecedented central bank gold buying. This is not a normal 20 years. If you run the same race from 1980 to 2000, gold gets destroyed. It fell from $850 to $280. The S&P 500 returned over 1,000% in that same stretch. Starting point matters. Ending point matters. The era you invest in matters. Gold produces nothing. No earnings, no dividends, no cash flow. Its price is pure sentiment. Fear, uncertainty, distrust of institutions. When the world feels stable, gold goes flat or drops. When the world feels like it's unraveling, gold runs. You're not investing in a productive asset. You're investing in a bet that the next 20 years will be chaotic. Given recent history, that bet has paid off spectacularly, but that doesn't mean it always will. The S&P 500 represents ownership in 500 of the most productive companies on Earth. Companies that innovate, hire, earn, and reinvest. Over any 30-year period in market history, stocks have never lost money. That's a track record gold can't match. And if the world enters a prolonged period of stability and growth, the S&P will leave gold behind like it always does. What nobody on either side wants to admit is this: the right answer depends on what happens next, and nobody knows what happens next. Sophia got lucky with her timing, Liam got unlucky with his, or maybe Sophia read the macro environment correctly, and Liam ignored it. It depends on who's telling the story. But here's the one thing that's not up for debate. If Sophia had panicked and sold during gold's 2013 to 2018 drought, she'd have missed everything. If Liam had panic sold during 2008 or 2020, he'd have locked in catastrophic losses. The real math isn't gold versus stocks. The real math is conviction versus panic. And the investor who wins is the one who picks an asset they understand well enough to hold through the years when it makes them look stupid. So the next time someone tells you gold always wins or the stock market always wins, ask them one question. Which 20 years are you talking about? Because the answer changes everything, and the only answer that matters is the one that includes every year, the ugly ones, the boring ones, and the ones that made your stomach drop.